You think your money in the bank is safe. You think FDIC protects you. But there's a law passed in 2010 that lets banks take your deposits to save themselves. And most Americans have no idea it exists. I need you to understand something right now. The money you have in your bank account isn't actually yours. Legally, the moment you deposit money into a bank, it becomes the bank's property. You become an unsecured creditor. You're lending money to the bank, and they're promising to pay you back. Most people don't know this. They think their checking account is like a safe deposit box. Money goes in, sits there, and you can take it out whenever you want. But that's not how it works. Your deposit is a loan to the bank, and like any loan, there's risk. Let me start with a history lesson. Because what's about to happen in America already happened in another country. And when you see how it played out there, you'll understand why you need to act now. Cyprus, 2013, small island nation in the Mediterranean, member of the European Union, modern banking system, everything seemed fine. And then one weekend in March, everything changed. The Cyprus banks were in trouble. They'd made bad investments. They had too much debt. They were on the verge of collapse. The government needed to do something fast. In the past, when banks failed, governments would bail them out. Taxpayer money would be used to save the banks. This is what happened in America in 2008. We bailed out the big banks with hundreds of billions of dollars. But in Cyprus, they tried something different. They did what's called a bail-in. Here's how it worked. On Friday, the banks were open normally. People went about their business. Then over the weekend, the government announced new rules. When banks reopened on Tuesday, anyone with more than 100,000 euros in their account would lose 47.5% of everything above that amount. Let me say that again. If you had 200,000 euros in the bank on Friday, when you checked your account on Tuesday, you had 150,500 euros. The bank took 47,500 euros. Just took it. No warning. No choice, no negotiation. People were devastated. Life savings gone overnight. Businesses couldn't make payroll. Retirees lost their retirement. And it was completely legal. The government passed a law over the weekend making it legal. This is a bail-in. Instead of the government using taxpayer money to save the banks save themselves by taking depositor money. Your deposits are used to recapitalize the failed bank. Now, you might be thinking, that's Cyprus. That's a tiny country. That could never happen here in America. And that's exactly what people in Cyprus thought before it happened to them. But here's what you need to know. The legal framework for bail-ins already exists in the United States. It was created in 2010 with the Dodd-Frank Act. And it's been refined and expanded since then. The Dodd-Frank Act was passed after the 2008 financial crisis. The stated goal was to prevent future bailouts. Congress was responding to public anger about using taxpayer money to save banks. So they created a new system. Instead of bailouts, we'd have bail-ins. Instead of taxpayers paying to save failed banks, the bank's creditors and depositors would pay. It was sold as making banks responsible for their own failures instead of forcing taxpayers to clean up the mess. Sounds good in theory, right? Banks should pay for their own mistakes. The problem is, when a bank fails, who are the creditors? You are. Your deposits are credits to the bank. You are an unsecured creditor, which means when the bank fails, your money is used to save it. The specific mechanism is called the Orderly Liquidation Authority. It's in Title II of the Dodd-Frank Act. This gives the FDIC the power to take over a failing bank and restructure it. And part of that restructuring can include converting deposits into bank equity. What does that mean in plain English? It means they take your cash deposits and give you shares of stock in the failing bank instead. Your money disappears from your account, and you become a shareholder in a bank that's collapsing. And here's the really sick part. They can do this without your consent. They don't need to ask permission. They don't need a court order. The FDIC has the authority to do this unilaterally during a crisis. Now, there are some protections. FDIC insurance covers up to $250,000 per depositor per bank. So if you have less than $250,000 in your account, you're theoretically protected. The FDIC will make you whole even if the bank fails. But here's what they don't tell you. The FDIC insurance fund has about $128 billion in it. Total bank deposits in the United States are over $18 trillion. Do the math. The FDIC fund covers less than 1% of total deposits. If we have a systemic banking crisis, if multiple large banks fail at the same time, the FDIC fund will be completely exhausted almost immediately. There's nowhere near enough money to cover everyone's deposits. So what happens then? The FDIC has to borrow money from the Treasury. The Treasury has to either raise taxes or print money to give to the FDIC. Either way, there will be delays. You might wait weeks or months to get your money back. And if they print the money, inflation will destroy its value anyway. But more likely, they won't even try to use FDIC insurance for large-scale failures. They'll use bail-ins instead. It's faster. It doesn't require congressional approval. It doesn't add to the national debt. It's the path of least resistance, and the legal authority to do it already exists. Let me show you how this would actually work in practice. Imagine it's 2026. The commercial real estate crisis has triggered widespread bank failures. Regional banks are collapsing. Panic is spreading. Depositors are trying to withdraw their money. The FDIC steps in. They invoke the Orderly Liquidation Authority. Over a weekend, they restructure the failing banks. Large depositors, anyone with more than the FDIC limit, their excess deposits are converted to equity. The bank is recapitalized with depositor money. The bank reopens on Monday. You check your account. If you had $100,000, you still have $100,000. You're fine. But if you had $500,000, you now have $250,000 in your account and shares of stock worth maybe $100,000 if you're lucky. You lost $150,000 overnight. And it's completely legal. You agreed to it when you opened your bank account. Buried in the terms and conditions you never read is language that says the bank can do this in a crisis. Business accounts are especially vulnerable. Most businesses have more than $250,000 in their operating accounts. Payroll, vendor payments, operating expenses, they need that cash. A bail-in would destroy them overnight. Wealthy individuals are also at risk. If you've been responsible and saved money, if you have more than the FDIC limit in your accounts, you're a target. Your excess deposits are considered available for bail-in. Even retirement accounts might not be safe. IRAs and 401ks held at banks could potentially be subject to bail-in. The rules are unclear, but the legal authority is broad enough that it could include these accounts. Now let me show you the evidence that this is actually being planned. This isn't conspiracy theory. This is documented fact. In 2012, the FDIC and the Bank of England jointly published a paper titled Resolving Globally Active, Systemically Important Financial Institutions. This paper explicitly discusses using bail-ins as the primary tool for resolving failed banks. The paper states that bail-ins are preferable to bailouts because they don't put taxpayer money at risk. It outlines how bail-ins would work in practice, and it recommends that all major countries adopt bail-in frameworks. In 2013, the Financial Stability Board, an international body of regulators, published guidelines recommending bail-ins as the standard approach for dealing with failed banks. The FSB includes representatives from the Federal Reserve, the Treasury, and other U.S. agencies. These aren't fringe documents. These are official policy papers from major regulatory bodies. They're openly discussing and planning for bail-ins. In 2015, the FDIC published its own guidance on bail-in procedures. They're required by law to have resolution plans ready for all major banks. These plans detail exactly how they would restructure each bank in a crisis. And bail-ins are a core component. Every major bank in America has a living will on file with the FDIC. This document explains how the bank would be wound down if it failed. And these living wills all include bail-in provisions. This isn't hidden. It's not a secret. It's all public information. But nobody talks about it. The media doesn't cover it. Banks certainly don't advertise it. So most people have no idea this framework exists. But it does exist. And it will be used when the next crisis hits. Now let me explain why 2026 is when this becomes real. Why is the timing important? Because multiple crises are converging. The commercial real estate collapse is accelerating. Over $1 trillion in commercial real estate loans are coming due between now and 2026. These loans were made when interest rates were near zero and buildings were fully occupied. Now rates are triple what they were and occupancy is down 30 to 50%. Property owners can't refinance at the new higher rates. The buildings aren't generating enough income to service the debt. Defaults are inevitable. And when the defaults happen, the regional banks holding these loans will face massive losses. We're not talking about one or two banks. We're talking about dozens or potentially hundreds of regional banks that are heavily exposed to commercial real estate. These banks don't have enough capital to absorb the losses. They will fail. When Silicon Valley Bank failed in 2023, it happened in less than 48 hours. Depositors started withdrawing money on Wednesday. By Friday, the bank was gone. $42 billion withdrawn in one day. The bank went from solvent to insolvent in hours. That was just one bank. Imagine that happening to 50 or 100 banks simultaneously in 2026. The FDIC won't have time to arrange traditional takeovers. They won't have enough money in the insurance fund. They will have to use bail-ins. It's the only tool that works fast enough and doesn't require massive amounts of government money. The residential mortgage market is also a time bomb. Millions of adjustable rate mortgages are resetting to much higher rates. Homeowners who could afford their payments at 3% interest can't afford them at 7%. Defaults are rising. Banks holding these mortgages will face losses. Not as severe as commercial real estate, but significant. This adds to the pressure on bank balance sheets. Credit card defaults are increasing. Auto loan defaults are rising. Student loan defaults are climbing. Every category of consumer debt is showing stress. This means losses for the banks holding this debt. The derivative exposure is massive. Banks are sitting on hundreds of billions in derivative contracts tied to interest rates and real estate values. When rates spike and property values crash, these derivatives will generate huge losses. We saw this in 2008. It's happening again. And the FDIC knows all of this. They're watching the same data we are. They see the commercial real estate crisis building. They see the consumer debt stress. They see the derivative exposure. They know a wave of bank failures is coming. That's why they've been quietly preparing bail-in procedures. They're getting ready to use this tool. They know they'll need it soon. So what do? How do you protect yourself from a bail-in? First, understand your exposure. How much money do you have in bank accounts? Is it more than the FDIC limit of $250,000 per bank? If so, you're at risk of bail-in for the excess amount. Don't think you're safe just because you're under the limit. The FDIC insurance fund is small. In a systemic crisis, there might not be enough money to cover everyone, even under the limit. And even if there is, you might wait weeks or months to get your money back. Second, spread your deposits across multiple banks. Don't keep everything in one institution. If you have $500,000, don't put it all in one bank. Put $250,000 in one bank, $250,000 in another. This keeps you under the FDIC limit at each institution and reduces your risk. Make sure the banks are actually different institutions. Having accounts at different branches of the same bank doesn't help. The FDIC limit is per institution, not per branch. Third, consider moving money out of banks entirely. If you have significant cash, you might be better off holding it in Treasury bills directly. You can buy Treasury bills through Treasury Direct, the government's own website. These are backed by the full faith and credit of the U.S. government. They're safer than bank deposits. Treasury money market funds are another option. These funds invest exclusively in short-term government securities. They're available through any brokerage. They're not bank deposits, so they're not subject to bail-in. And they're safer than keeping large amounts in a bank. Fourth, reduce the amount of cash you hold, period. Cash is vulnerable to both bail-ins and inflation. If you have more cash than you need for immediate expenses and emergency fund, you should probably be in other assets. Gold and silver are physical assets that can't be bail-ined. They're not in the banking system. They're not someone else's liability. You own them outright. In a banking crisis, precious metals hold their value while bank deposits are at risk. Real estate is another option. Property can't be seized in a bail-in. It's a real asset with intrinsic value. If you have excess cash sitting in a bank, using some of it to buy property reduces your bail-in risk. Stocks are also outside the banking system. If you own stocks in a brokerage account, they're not subject to bail-in. They're not bank deposits. They're not liabilities of the bank. They're separate assets. The key is to get money out of the banking system and into real assets or government securities that aren't vulnerable to bail-in. Fifth, if you're a business owner, this is critical. You probably have significant operating cash in business accounts. This is extremely vulnerable to bail-in. Most business accounts hold more than $250,000. All of that excess is at risk. Consider keeping only what you need for immediate operations in your business bank account. Move excess cash to Treasury bills or money market funds. You can access it quickly if you need it, but it's not sitting in a bank where it can be bailed in. Some businesses are setting up accounts at multiple banks to stay under the FDIC limit at each one. This is better than keeping everything in one bank, but it's not a perfect solution. You're still exposed to delays and potential FDIC fund exhaustion. Sixth, be aware of the warning signs. When the bail-ins start happening, there will probably be some advance indicators. Bank stocks will be crashing. Credit default swaps on banks will spike. News will report problems at specific institutions. When you see these warning signs, act fast. Move money out of vulnerable banks immediately. Don't wait to see what happens. Don't hope for the best. The Cyprus bail-in happened over a weekend. By the time people realized what was happening, it was too late. Speed matters in a banking crisis. The people who get their money out first are fine. The people who wait get caught in the bail-in. Seventh, understand that there might be restrictions. During a banking crisis, the government might impose capital controls. They might limit withdrawals. They might close banks temporarily. They might restrict transfers. This is why you need to act before the crisis, not during it. Once the crisis starts, your options will be limited. Cyprus imposed capital controls after the bail-in. People couldn't move money out of the country. Daily ATM withdrawal limits were imposed. It took months for things to return to normal. This could happen here. Eighth, don't assume your bank is safe. Even if your bank seems healthy today, that can change quickly. Silicon Valley Bank looked fine one day and was gone 3 days later. Banks can fail very fast in the modern financial system. And remember, in a systemic crisis, even healthy banks can get caught up in the panic. If depositors are pulling money out of multiple banks, fear spreads. Bank runs can happen at institutions that are actually solvent. The mere fear of failure can cause failure. Ninth, educate your family and business partners. Make sure everyone who has significant deposits understands the risk. Your spouse needs to know. Your business partners need to know. Your parents need to know if they have significant savings in banks. This isn't something to keep to yourself. The more people who understand bail-in risk, the more people who can protect themselves. 10th, Monitor your accounts closely. Check your balances regularly. Make sure no unauthorized changes have occurred. In a crisis situation, mistakes happen. Money gets moved incorrectly. You want to catch any problems immediately. Now let me address the objections. I know some of you are thinking, the government wouldn't let this happen. They wouldn't let banks take people's deposits. They already did in Cyprus, and they've set up the legal framework to do it here. The government's priority is financial system stability, not protecting your deposits. FDIC insurance will protect me, maybe for amounts under $250,000 if the crisis isn't too big, if the FDIC fund doesn't run out, if you're willing to wait for your money. But that's a lot of ifs. And if you have more than the limit, you're definitely not protected from bail-in. Oh, my bank is too big to fail. That's what people thought in 2008. That's what people thought about Silicon Valley Bank. Banks fail, even big banks. And when they fail in a systemic crisis, bail-ins are how they'll be handled. This is fear-mongering. No, this is reality. The legal framework exists. The policy papers are published. The historical precedent is there. Cyprus happened. This isn't speculation. This is documented fact. I don't have enough money to worry about this. If you have more than a few $1,000s in the bank, you should worry about this. Even if you're under the FDIC limit, delays in getting your money back during a crisis can cause serious problems. Not being able to access your cash for weeks could mean you can't pay rent, can't buy groceries, can't handle emergencies. Let me be very clear about something. I'm not saying to never use banks. Banks are necessary. You need checking accounts for daily transactions. You need business accounts to operate. I'm not suggesting you go completely bankless. What I'm saying is don't keep more in banks than you actually need. Don't treat your bank account as a long-term savings vehicle. Don't keep 6 months or a year's worth of expenses sitting in a checking account. Don't keep business reserves in your operating account. Keep what you need for immediate use in the bank. Put everything else in safer places. Treasury bills, money market funds, precious metals, real assets. This isn't radical. This is just prudent financial management given the risks we're facing. Now let me paint you a picture of what the 2026 bail-in might actually look like. It's a Friday in late 2026. News breaks that a major regional bank is in trouble. They've announced massive losses on commercial real estate loans. Their stock is crashing. Depositors are getting nervous. By Friday afternoon, people are lining up at branches to withdraw cash. ATMs are running out of money. Online banking is overwhelmed. Social media is full of panic. Over the weekend, the FDIC steps in. They invoke emergency powers under Dodd-Frank. They announce the bank is being restructured. Trading is halted. Accounts are frozen. On Monday morning, the bank reopens. A press release announces the successful restructuring. The bank is now solvent. Crisis averted. But when depositors check their accounts, the amounts are different. Anyone with more than $250,000 has lost money. The excess has been converted to stock in the restructured bank. The stock is worth a fraction of the original deposit value. Business owners discover they can't make payroll. The money they thought was in their account is gone. They've been given worthless stock instead. Retirees who had their life savings and CDs at the bank find their principal has been partially seized. They were counting on that money to live on. Now it's gone. Panic spreads to other banks. Depositors at similar institutions rush to withdraw their money. More banks face runs. More failures. More bail-ins. The crisis spreads. The government tries to calm people down. They say the financial system is sound. They say deposits are protected. They say everything is under control. But people see what happened. They know deposits aren't safe. They know bail-ins are real. The trust is broken. This scenario isn't speculation. This is based on what happened in Cyprus and what the regulatory framework allows. This is what 2026 could look like. And here's the really disturbing part. Most people won't see it coming. They'll have no warning. One day their money's there, the next day it's gone, just like Cyprus. The people who will survive are the people who prepared, the people who understood the risk, the people who moved their money to safety before the crisis hit. So the question is, which group will you be in? Will you be someone who prepared and protected yourself? Or will you be someone who ignored the warnings and lost everything? The information is available. The legal framework is documented. The historical precedent exists. The warning signs are clear. You have no excuse for ignorance. You have no excuse for inaction. Let me also address the international dimension of this. Bail-ins aren't just an American thing. The G20 countries agreed in 2014 to adopt bail-in frameworks as the standard approach for dealing with failed banks globally. This means every major country has implemented or is implementing bail-in laws. Europe has them, Canada has them, Australia has them. If you think you can escape this by banking in another country, you're wrong. The same risk exists everywhere. The only real protection is to get money out of the banking system entirely and into assets that can't be bailed in. Physical gold, real estate, stocks, treasury securities. These are international. They're not subject to bail-in regardless of which country you're in. Now let me talk about the political dimension. Why won't politicians stop this? Why won't they protect depositors? Because the alternative is worse from their perspective. If they forbid bail-ins, then failed banks have to be bailed out with taxpayer money. After 2008, the public is violently opposed to bank bailouts. No politician wants to vote for using taxpayer money to save banks. Bail-ins solve this problem. Banks save themselves using depositor money instead of taxpayer money. It's politically easier, even though it's devastating to the people who lose their deposits. Also, most politicians don't understand the details. They passed Dodd-Frank without fully reading or understanding it. The bail-in provisions were buried in technical language. By the time anyone realizes what they voted for, it's too late. And frankly, many politicians keep their wealth in assets, not cash. They own stocks, real estate, businesses. They're not vulnerable to bail-ins, so they don't see it as a personal threat. They're protected, while ordinary people bear the risk. This is why you can't count on the political system to protect you. The incentives are all wrong. Politicians have reasons to allow bail-ins and no strong reason to prevent them. You are on your own. Your protection is your responsibility. The government will not save you from this. Let me give you a specific action plan for this week. Action 1. Calculate your total bank deposits. Add up everything across all accounts. How much money do you have in the banking system? Write down the number. Action 2. Identify your vulnerable accounts. Which accounts have more than $250,000? These are at immediate risk of bail-in. Which accounts have enough money that losing access for weeks would cause serious problems? Action 3. Open accounts at other institutions. If you have money concentrated in one bank, open accounts at one or two other banks. Spread your deposits so no single bank has more than $250,000 of your money. Action 4. Open a Treasury Direct account. Go to Treasury Direct, Gov, and set up an account. This lets you buy Treasury bills directly from the government. Start moving excess cash into T-bills instead of leaving it in banks. Action 5. Open a brokerage account if you don't have one. Fidelity, Schwab, Vanguard, any major broker. Set up a Treasury money market fund. This gives you another option for parking cash outside the banking system. Action 6. If you own a business, audit your business accounts. How much operating cash do you really need? Move excess amounts to Treasury bills or money market funds. Keep only what you need for immediate operations in the bank. Action 7. Buy some physical gold or silver, even just a few ounces. Something tangible outside the financial system. This is insurance that can't be bailed in or frozen. Action 8. Talk to family members with significant deposits. Make sure they understand bail-in risk. Help them protect their money. Your parents especially might have significant savings at risk. Action 9. Review your retirement accounts. Are they held at a bank or a brokerage? If they're at a bank, consider moving them to a brokerage where they're not subject to bail-in risk. Action 10. Set up alerts on your accounts. Most banks let you set up text or email alerts for large transactions or balance changes. Turn these on so you're immediately notified of any unusual activity. Do these 10 things this week, not next month. This week. The crisis is coming. You don't have unlimited time to prepare. Every week you delay is a week closer to the bail-ins. Every month you put this off is a month you're at risk. Now let me be absolutely clear about the timeline. I don't know exactly when the bail-ins will start. Nobody knows the exact date. But based on the commercial real estate crisis, the bank balance sheet stress, and the timing of loan maturities, late 2026 or early 2027 is when things get critical. That gives you maybe 12 to 18 months to prepare. That's not a long time, especially if you have significant assets to reorganize. Don't wait until the last minute. The people who get caught in bail-ins are the people who ignored the warnings, the people who thought it couldn't happen here, the people who trusted that someone would protect them. Don't be one of those people. Be someone who saw the risk and took action. Be someone who protected their family and their wealth. Be someone who was ready. If this video opened your eyes to the bail-in risk, share it with everyone you know. Your family needs to see this. Your friends need to understand this. Your business associates need to prepare. Help spread this information. Subscribe if you haven't already. I'm going to continue covering the banking crisis, the regulatory framework, and strategies for protecting your deposits. This is one of the most important financial risks we face. Leave a comment. Let me know if you are aware of bail-in laws. Tell me what you're doing to protect yourself. Are you moving